Welcome to the Furlo Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission, if you're new here, is to equip people to invest wisely in both property and people so that together we can build our wealth while improve housing. I'm James, and this is my wife, Jessie.
Hi, I'm here.
Hey, you're here. How's it going?
It's good. As I was listening to you say our intro, it made me think of, like, we're teaching people to invest in things and people wisely, and it just made me think of our kids and how we've had recent conversations about, like, are you spending money wisely? And
yes.
Why would you spend on that? And what would that mean?
Our daughter, she really wants a Stanley Cup.
Oh, the Stanley Cup. Makes me think of hockey every single time.
She's on trend. I mean, it makes sense.
She's on trend, yeah. So I'm like, I had this, heart check where I was like, did I do that as a kid? No way. I bought things to fit in and was like, oh no, I totally did that as a kid.
I had a sweet JanSport backpack.
Right? Had an Nalgene.
We all got it.
We all do it. Yeah. So.
Yeah. What I actually want to talk about today is a poor financial decision that somebody made. Right. And so a little bit of context. We've got a house under contract that we're going to buy. Mm-hmm. We have a closing date, but we're probably not going to hit that closing date because the seller, the current owner, has a pretty big issue that we're trying to work through and figure out.
Wow.
And he's gotten himself into a bit of a pickle. And so a bit of this episode is a PSA. If you hear this, don't do it.
Do it.
Yeah. So
all right.
Here's what happens. When you get a property under contract, the very first thing that they do is they pull what's called a preliminary title report. Okay. Essentially, they see, does anybody have any claims to this property? And effectively what you want to do is, A, make sure the person you're buying it from has the right to sell it.
Yeah.
Because that's not always true. And B, is there anyone else who has claims on the money prior to that buyer getting it?
Follow-up question.
Yeah.
Can anybody pull one of those at any time?
That's a good question.
I don't know why you would need to if you weren't going to buy it.
Yeah. I mean, it's all public records.
Although,
yeah.
If somehow it got missed or something and you want to see it for your own house.
Oh,
I don't know.
Yeah, you can. It's tricky. So oftentimes you'll go through an escrow or title company, and they'll just pull it for you.
It's kind of the process of it happens within the process of buying a house.
Yes.
Okay.
Yeah. Because ultimately that insurance. So the whole point of like escrow / a title company is they give what's called title insurance. It's insurance that basically says, we're willing to ensure that you are the rightful owner of this property now. And if someone else comes out of the woodwork and says, whoa, time's out.
It's actually
mine. Yeah, they go, we'll insure you. We'll essentially give you your money back if that happens. Yeah, that's so part of what they do is they do the research because they want to make sure that they're insuring something that's good to say, does anyone else have any rights to this property? Yeah, that's the whole point of it. So we ran it for this guy's property. And one of the things that pulled up was called a deed of trust to secure an indebtedness in the amount shown below, and it was $58,000. And what was weird about this one was what it was. Because anytime you get one of these, and we're working through Fidelity National, is they have little hyperlinks that take you to the original deeds and documents that were recorded with the city, because we just get a summary.
Okay.
And so we get this document, and I start reading through it, and I'm like, I can't tell what this is. Like, it seems like a loan, but it's not a loan, because it's kind of like it's written like one, but there's no, like, the language was just weird. And so what I have now gotten into the habit of doing is when I get a document like this and I'm like, there's just a lot going on here, I will instantly upload that to ChatGPT and just be like, give me a summary. What's going on here? And that's what I asked it. I was like, what is this? And it came back. And so I asked it, I was like, what is this thing? And I went, well, it's kind of this two peats. It's a deed of trust, which is a loan component. And then there's this option to purchase. I was like, this option to purchase?
Yeah.
What are you talking about? And so I was like, wait. So I asked it, I actually said, is this a loan or is this an option to purchase? Like I don't understand. Because in my world, a loan is we've given you money and you have to pay it back
with interest,
for some amount of money.
Under some terms.
An option to purchase is I pay some money with the option to buy your property at a later date.
Yeah.
And I can choose to exercise that option or not. Like, those are two fundamentally very different things.
Yeah.
One is like, I'm letting you borrow some money. The other is,
I mean, I could see
I'm giving you money
how you
so
could
I have...
squish them together and say,
Well,
like,
let me
I'm
tell
gonna give
you
you some money,
exactly how
but
that
if you
works.
don't pay it back, then you could buy it from me.
Yeah, kind of. So I asked it. I was like, I don't understand. Which one is it? And I was like, it's kind of both. I was like, okay. And so it was talking about how it's a security instrument used to secure a loan, and it had a grantor and a lender, and the loan component of it is backed by the property. And so in some ways it is acting like a loan, but in another way it's acting like an option to purchase, where it specifies there's an option agreement where the beneficiary has the option to purchase a percentage interest in the property. The beneficiary being like the lender in this case. They're not a lender, but that's, and I was like, okay,
So is that
a percentage.
like the bank who holds the mortgage?
So kind of. It's totally weird. So I kind of like, so I'm reading this thing, right? And I'm going through what you're going through. I'm like, wait, I don't understand. Like, what is this thing? And so I started doing some more research, right? And I was like, okay, what? So finally I changed tactics and I went, tell me about this company. Because in the title report, it tells you who they owe money to.
Okay.
And usually, so what happens is when you're buying a place and there are these other loans, the escrow agent will reach out to those companies and say, hey, what's your what do they call it? Your payoff statement, essentially. What's it going to take for you to be like, we're good?
Yeah.
And so they have all their info and contact information. So I was like, who are these guys? So I started looking them up. And so they are a fintech company, financial tech company, that specializes in home equity financing. Okay? Which at first I'm like, sounds like a HELOC.
Yeah.
Right?
That's where my head jumped, was like, it's a line of credit?
Yeah. So they were founded in 2015, and they make what's called an home equity investment, which allows, home equity investment. That is the magic buzz term, which allows homeowners to assess a portion of their home's equity in exchange for a share of a future value of the home. Okay? This can be an alternative to traditional home equity loans or lines of credits. All right. So here's how it works. You get, let's say, I need some money. Okay? They go, sweet. We would like to invest in your home. In this case, we will give you $58,000. And in return for that, when you eventually sell, not only will we get our initial $58,000, but we get some percentage of the sale of your home when you do it. And this thing lasts for 30 years, and they have an option to extend it for another 30 years, essentially covering your lifetime.
Wow.
It's an intriguing idea, right? It's like, and so for the borrower, no interest, no payments. It's just in the future, some mythical future, when I eventually sell my house, and ideally if it goes up in value, cool, yeah, I just don't get to keep all of it.
Yeah, but it's a lot more like a credit card when you shouldn't have one. I get that you are leveraging it against your home equity, which, okay, at least you have something to pay it back with, assuming you sell.
Yeah.
But it's also like, why don't you just take out a line of credit and then pay that back? Like, because the line of credit doesn't leverage your house,
typically,
right?
All right, here's some of their benefits that they offer.
Give you interest.
That they offer their customers. Homeowners can use the funds for various purposes, such as paying off other debts, making home improvements, or covering a large expense.
So they don't have to use it for their home.
30-year term, and they can repay the investment at any time without prepayment penalties. So if they wanted to,
they could
pay off. They could. It is inclusive and accessible, according to their website. They aim to provide financial inclusivity by offering their products to homeowners with diverse credit profiles. In other words, bad credit. Making it easier for those who might not qualify for traditional financing to access their home equity. So here's the deal. You don't qualify for a home equity loan because you just got bad credit. And banks are like, no.
Yeah.
So these guys come along and go, yeah, sure. we don't care because you don't have to make any payments. All that matters is when you sell, we get a percentage of it.
Yeah, it's totally a credit card. When you're like, no,
well, you have
don't
to make
worry
payments on a
about
credit
it.
card. You have to make payments on a credit card. This is different. This is fundamentally
You're right.
different.
It's like a shady loan.
It's
It's like, oh, I know you can't pay this back, but don't worry. We'll just take it out of your home sales when you sell later.
So imagine,
I mean, think
of it.
like,
No, think of it this way. Think of it this way. Let's pretend you want to make a massive home improvement because you're going to sell your home. And you're like, this is going to take...
That's like the one and only scenario.
But this is going to take 2 years for us to do it, okay? You could say, yep, I want to access some of my home equity now so I don't have to make any payments because, whatever. I'm going to take the 2 years, make all those improvements, and then I'm going to sell it.
Yeah.
And I'm going to increase the value by more than what that percentage is.
Yeah.
Yay. We all win.
That makes sense to me.
Yes.
It does not make sense to me to say, oh man, I'm strapped for cash. Like, I'm going to use this 58 grand now to live on, to buy a boat, to do whatever I want, because I don't have to worry about it.
Well, yeah, which that's on the person and the borrower and the owner, not the company.
Yes, although they're offering these services.
You could do the exact same thing with a HELOC or a home equity loan.
You could.
There's no difference here.
You could.
That has nothing to do with the company.
I thought you had to use a HELOC for your house.
No, not at all.
You could use it to buy a boat or do whatever you want with.
Yeah, well, we used our HELOC to buy another property.
Oh, yeah.
So, no, you don't have to do anything. Yeah. No, it doesn't matter.
All right.
Yeah, so it's an interesting...
It seems like it could be used responsibly. In this particular case, do you think it was used responsibly?
I think part of the problem is... So there's a critical piece of information here that we've left out, which is, what is that percentage?
Oh yeah.
Because if it's 1%, cool, that's fine. If it's 50%, okay, that's a different beast. Which on their website they're very explicit about saying it varies. It depends on the situation, which could be read as depends on how desperate you are.
Interesting.
Or I've also read it as it depends on how much money you're asking for relative to the value of your home, kind of scales. But here's what's critical is when you get a home equity investment, when you sell, you owe a percentage plus whatever that original amount was. So in this case, he owes $58,000 plus whatever that percentage is. And based on research, it is typically somewhere between 5 and 10%.
Okay.
So if he sells his house for $40,000 and it turns out that it's 10%, he doesn't just owe the $58,000, he owes the $58,000 plus the $40,000, which that is an incredible interest rate when you think about when he took it out, which was in 2022. That's the kind of thing where you go, okay, so it's been 2 years. A normal interest rate might be 12. Let's just easy math. Maybe it's 10%. On $58,000, that's around $5,000. And in this case, if it's at a 10% based on the value, it's 4 times your normal interest rate.
Yeah.
And I get
because it's based on the bigger number.
Yeah. Because it's
not the loan value.
Right. Yeah. But he didn't have to make any payments, so it's just a minus. Basically,
but he does now.
What we've learned. Based on trying to figure out how much he owes, which they're being really cagey about it, which is interesting. Oh, I totally forgot. There's another thing that's a piece to it. They have first right of refusal when you go to sell. Yeah.
Oh.
Yeah. So that's another piece. Because you could, in theory, see a situation where you go, hey, I'm going to sell this to my Uncle John, who I trust, for $1. And then he goes, so I owe you guys $58,000 plus 20 cents. Or whatever, right? And then he trusts Uncle John, and then Uncle John resells it back to him for $1, the next day. Boom, we're all good, that kind of thing, or something like that. Or I don't know, he sells it to Uncle John for $58,000. You know what I mean? You can set this up in such a way where that percentage becomes meaningless. But they have first right of refusal. So if you come along, let's say you're like me, looking for a deal, they could decide to get an appraiser on the property and say, no, it's actually worth a whole lot more because James was good at negotiating. We're going to buy it at that price and take it. So
interesting.
That is something that we're like, oh, this could happen to us where we've got this under contract. So we're holding off on raising any funds right now because like it just wouldn't look good to go out, get all the investment, get ready to rock. And then this company comes in and say, yep, thank you. Because then they'll just relist it and that's how they'll recoup their funds. They don't care. And they'll still get their $58,000 plus 5%. So it's an interesting...
So what's your next step? Are you talking with that company to...
Yeah, well, we're not, but the escrow person is.
Oh.
And
they're trying to suss out, like, are you going to buy this? Are you not? What's your stake?
Well, they know we're going to buy it. We are trying to suss out what their plans are.
Yeah, that's what I'm saying.
Oh, sorry. Oh, you meant when you said they, you meant the escrow person.
The escrow person is talking to the company for you.
Yeah. So that's our thing. Based on what we can see, it's probably not worth it for someone. The allure of not having to make any payments is true, and I get that this guy had some health issues and like it was dire straits and he might have potentially lost his house if he didn't do this. And so it's still a better outcome than otherwise. I get that. But at the end of the day, it's like it was not a fantastic deal. But who knows? Maybe he is on like 1 or 2%. We don't know. They're not telling us, which I think is weird.
Talk with the owner and ask what he took the money out for? Like, I don't know if that matters.
We didn't really ask. It wasn't super important. And he couldn't find his loan docs. Or his, whatever we're going to call this, home equity investment docs. So we couldn't look at what he signed up for. So, yeah, it's a sticky situation.
Yeah.
But anyways, my point is, if you run across a home equity investment, my recommendation would be to kind of keep searching. It sounds like these guys, they're classic hard sales, hard close types of tactics. And now that we're trying to close, they are, once again, just being weird about it. It's not as straightforward as like a traditional bank of like, yep, here's how much we owe. They're more like, tell us more. What is the transaction? How are they setting it up? What's the structure? Because they're thinking about like, oh, we might just take that, which is a weird situation to be in. Yeah, very interesting. Anyways, just want to share that. That's my PSA. Don't do it. And if you come across an owner who has that, be prepared for weirdness to ensue.
All right.
Yeah. So there you go. That's what we've got. So if you enjoyed this podcast and learning about home equity investments, we would love it if you left a review wherever it is that you listen to podcasts. And if you are interested in learning more about investing with us, you can check us out at furlo.com. Thanks for listening and have a great day.